Hi, this is Brenda Green and welcome back to Living Indigo. So today I'm giving you a few more financial terms, and I'm sure you've heard these, but I'm going to just break it down a little bit more so you have a better understanding of them. And especially if you want to use it and share it with other people, you can explain it to them too. So the first term I have for you is collateral, and you've probably all heard of that, but let me give you the definition. So collateral is an asset that a borrower offers a lender as security for the loan. So for example, if you get a mortgage, your house becomes a collateral back to the bank or the whatever lender it is, because if you default, they can take that from you. So that's the collateral. Same thing with when you buy a car. Well, the car is collateral back to the lender who gave you the loan for the car. So if you go in default, they will repossess it and they will be able to sell it and recoup their loans. So that's what collateral means. Sometimes with a business, they might want to expand and they need more money, they need a loan. So they might use as an asset their real estate, wherever the business is located, or the equipment that the company has. So that's collateral, and they will use that in order to insure. You've heard of, like, if you don't pay, that you go in default, they will seize that collateral and try to sell it to get what they need. So the reason that lenders, banks, credit unions, or whatever, need to have collateral in order to secure the loans is because it minimizes their risk for the loan. So they're not just going to give you a loan and hope you pay it back. They want us to have some insurance that they will get their money. So that's what collateral is. Now, another definition or financial term that you've heard a lot about is compound interest. And that's interest that's added to the initial principal of an investment or a loan, increasing the balance and increasing the interest earned or paid in that next period. So for example, it's called the power of compounding, right? So if you have a credit card bill and it's $5,000 and the interest is 25%, if you don't pay that bill on time or pay the full amount, every month they're tacking on 25% interest. So that continues to grow, and it's very hard to bring it down. But for instance, if you have a savings account, and you put money in there, you have compound interest. So each and every month you get more because of the interest compounding. So that's why people love compound interest. I love it myself. Let me give you an example. Let's say you have $100 in your savings account, and I'm gonna give some exaggerated amount here. Let's say you get 10% every month. So the first month you put the 100 in, at the end of the 30 days, you're gonna have $110 in there because they're gonna give you 10% interest. The next month, you're starting your balance with $110, another 10% interest. That's going to add $11 more to it. So your total at the end of the second month will be $121 because of the interest. That's compounding interest, and so on and so on. I have a couple of savings accounts where the interest rate is 4%. So every month, like clockwork, it's getting 4%, which I love. It's like passive income, right? I don't have to do anything for it, and it just rolls into my account. So that's the beauty and the love of compound interest and the beauty of compounding. So a little bit of information for you. Hope that helps. Thanks so much and have a wonderful day.